Picture this, an 80-year-old woman sitting in a home worth $1.4 million, a house she paid off decades ago, completely mortgage-free, and yet she is scraping by on a part pension, turning off her heater in winter because she cannot afford the electricity bill. This is not a rare story. This is the reality for hundreds of thousands of Australian pensioners in 2026. Across this country, retirees are sitting on a combined property wealth of well over $1 trillion, and yet so many of them are what experts call asset-rich and cash-poor. They own the bricks, they own the land, but they cannot touch the money that is locked inside those walls. So today we are asking the question that so many families are quietly asking around the kitchen table right now. If pensioners genuinely own billions and billions of dollars in property, why in 2026 is it still so difficult for them to access their own equity when they need it most? Welcome back to Aussie Benefit, the channel where we break down superannuation, pensions, and retirement finances in plain English so you actually understand what is happening with your money and your future. If this is your first time here, hit that subscribe button right now, because every single week we uncover the truth behind government policy, Centrelink rules, and the financial system that so often works against everyday retirees instead of for them. And if you already know this channel, then you know the drill. Smash that like button before we even get started, because it genuinely helps this video reach more retirees who desperately need this information. Now, in this video we are going deep into the property equity trap. We are going to explain exactly why so many pensioners cannot get their hands on their own wealth, what options actually exist right now in 2026, what the government has changed, and what mistakes you absolutely need to avoid if you are sitting on a valuable home but living week to week. Stick around until the end, because we are going to walk through real strategies that could change your financial situation this year. So let's get into the heart of the issue. Australia has one of the highest rates of home ownership among retirees in the world. Depending on the state, somewhere between 70 and 80% of pensioners own their home outright. On paper, that sounds like an incredible retirement success story. But here is the twist that nobody talks about enough. The age pension means test in Australia treats your home very differently to every other asset you own. Your primary residence is completely exempt from the assets test, no matter how much it is worth. That sounds like a good thing at first, right? It means your million-dollar house does not reduce your pension payments. But the flip side of that exemption is brutal. Because the home is exempt, Centrelink and the broader retirement system essentially treats that wealth as untouchable and irrelevant to your day-to-day living costs. The result is a strange contradiction. You can be a millionaire on paper because of your property, while your actual bank account has a few $1,000s in it, and you are still eligible for close to a full pension. That might sound fine until you actually try to live off that pension in an economy where electricity, groceries, insurance, and council rates have all skyrocketed. The equity sitting in your walls does nothing for your weekly budget unless you find a way to release it. Now here is where the real problem begins. To access that equity, pensioners historically had very few good options. Selling the family home is emotionally devastating for most retirees, and it also risks pushing them into the private rental market at the worst possible time in their life, especially with rental prices in most Australian cities remaining incredibly high through 2025 and into 2026. Downsizing sounds like a reasonable middle ground, and the government has tried to encourage it through the Downsizer Superannuation Contribution Scheme, which allows eligible retirees to put up to $300,000 from the sale of their home into their super without it counting against normal contribution caps. That is helpful for some people, but downsizing is not simple. Stamp duty, moving costs, agent fees, and the emotional toll of leaving a home filled with decades of memories mean many retirees simply refuse to go down this path, even when it might make financial sense. Then there is the other major option, the Home Equity Access Scheme, which used to be known as the Pension Loan Scheme. This is essentially a government-run reverse mortgage. It allows eligible Australians of pension age to borrow against the value of their property and receive it as a fortnightly payment or, since recent reforms, even as a lump sum advance. On the surface, this seems like the perfect solution to the exact problem we are describing. But in reality, uptake of this scheme remains surprisingly low. Many retirees simply do not know it exists. Others are wary of taking on debt in their later years. worried about what it means for the inheritance they want to leave behind for their children. And there is a real, valid concern here too, because compounding interest on a reverse mortgage-style loan can significantly erode the equity in a home over 10 or 15 years, especially if property values in a particular area do not rise as quickly as expected. So while the scheme exists, many financial advisors warn that it needs to be used cautiously and strategically, not as a default fix for cash flow problems. Private reverse mortgages from banks and specialist lenders are another avenue. And in 2026, more lenders have entered this space than ever before, but interest rates on these products remain considerably higher than standard home loans, and the fees involved can be substantial. Add to this the fact that many pensioners are simply not comfortable with modern lending processes, banking apps, or navigating financial paperwork without support, and you start to see why access to equity, despite being technically available, still feels practically impossible for so many older Australians. There is also a broader systemic issue at play. Financial products designed for equity release were largely built with younger, financially literate borrowers in mind. They were not designed around the needs, fears, and comfort levels of an 85-year-old widow who has never taken out a loan in her entire life. This mismatch between financial product design and the actual pensioner population is one of the quiet reasons why billions of dollars in property wealth remain locked away and unused. So what is the real solution here in 2026? It is a combination of better financial education, more accessible and transparent government schemes, family conversations happening earlier about inheritance expectations, and genuinely independent financial advice before locking into any equity release product. If you are a pensioner sitting on valuable property and struggling with day-to-day cash flow, please do not make a decision based on a quick chat with a bank employee alone. Speak to a licensed, independent financial advisor who specializes in retirement planning, and consider services like the National Debt Helpline or the government's free financial information service through Centrelink before signing anything. That brings us to the end of today's breakdown. If this video helped you understand why property wealth and pension poverty so often exist side by side in Australia, do us a huge favor and hit that like button right now. It genuinely makes a massive difference to this channel. And if you have not subscribed yet to Aussie Benefit, now is the perfect time, because we are releasing new videos every single week covering exactly this kind of retirement and Centrelink content that mainstream media simply will not explain properly. Drop a comment below and let us know if you or someone in your family has faced this exact equity trap. We read every single comment and often turn your questions into future videos. Thank you so much for watching. Take care of yourselves and your finances, and we will see you in the very next video.